Hi everyone. Earlier today we announced our financial results for the half year. The outcome for the group was a statutory net profit after tax of $158 million, up 12.8%. We also announced statutory earnings before interest and tax of $257 million, up 6.6%. While our statutory result was up on last year, the underlying result was down, reflecting our investment in the Australian Accelerated Growth Plan, in line with the commitments that we communicated to the market last year. Our results included an excellent performance from New Zealand and strong performances in our Fiji and alcohol and coffee businesses, with revenue, volume and EBIT growth in each market. I'm also pleased to say that we're starting to see some encouraging signs in Australian beverages, with an improving volume trajectory in both sparkling and still beverages as our Accelerated Australian Growth Plan gains traction. In Indonesia, our result was affected by soft market conditions, and while the team is continuing to deliver efficiency savings, these haven't been quite enough to deliver EBIT growth over the first 6 months of the year. In Papua New Guinea, we were cycling the pre-election stimulus of the first half of 2017 and managing through some operational issues that impacted our performance. While challenges remain across parts of our business, we've achieved a lot in the first half. We secured some significant customer renewals in the quick service restaurant channel in Australia, including Hungry Jack's and Craveable brands. We launched a global first for the Coca-Cola system with Coca-Cola 100% Stevia in New Zealand. In Indonesia, we continue to invest in our manufacturing facilities, our route to market, and most importantly, our people. In alcohol, we saw Canadian Club deliver exceptional growth through effective marketing and strong execution. And in coffee, we've invested in some really exciting growth initiatives for the future. We've committed to increasing the proportion of recycled PET across our portfolio to a net 50% by 2020, and we've released our first range made entirely from 100% recycled PET. And more recently, we announced our first investment under our Amatil X platform, taking a minority share interest in Doshii, an exciting company which integrates point-of-sale systems with ordering, payment, loyalty and reservation apps. All of this and more was possible because of the contribution our people and our teams make every day across Amatil. I'll now hand over to Martin Roberts, our Group Chief Financial Officer, who'll share with you some of our financial highlights.
Thanks, Alison. In Australian beverages, we stabilised revenue and volume as a result of the investments we're making in the Australian Accelerated Growth Plan. The impact of these investments and the introduction of the Container Deposit Scheme in New South Wales has resulted in an already communicated reduction in profit this year. While there's more to be done, we're really pleased with the progress of this plan so far. New Zealand and Fiji had an excellent half, with strong growth in revenue and EBIT in both markets. Well done to everyone involved. We delivered low single-digit EBIT for the Indonesia and PNG segment on a constant currency basis. As we previously flagged, we've had a challenging start to the year in both markets. However, I know the teams are committed to coming back strong in the second half. Turning to alcohol and coffee, continuing revenue growth and double-digit EBIT growth in our core business funded investments in a number of growth initiatives in the business, including progressing the expansion of our coffee business in Indonesia. Earnings in our corporate, food and services segment declined, reflecting a number of movements, such as a modest loss in SPC, lower earnings in the property division, and investments in Amatil X and group capabilities. It's important to note that our balance sheet remains in a very strong position, and our return on capital employed is still above 20%, an excellent position to be in. Looking ahead, we remain committed to our shareholder value proposition and to delivering against our targets in the medium term. Our outlook does, however, remain subject to the success of revenue growth initiatives in Australia, Indonesian economic factors and regulatory conditions in each of our markets. And with that, I'll now hand back to Alison.
Thanks, Martin. Today we announced the commencement of a strategic review to consider options to deliver future growth of SPC, Australia's leading processor of packaged fruit and vegetables. The review coincides with the completion of a 4-year $100 million investment in SPC, in which the Victorian Government contributed $22 million. There are many opportunities for growth in SPC, including new products and markets, further efficiency improvements, and technology and intellectual property. The review will look at how this growth could be unlocked, potentially through a change in ownership, alliances or mergers. At Amatil, we're really proud of the transformation that's occurred at SPC over recent years, and I only see a positive future for this great business. And now is the right time to make sure it's best positioned to deliver against its potential.